Hello and welcome to the FT headquarters. I have with me Steve Brice, Chief Investment Strategist at Standard Chartered Private Bank. Steve, December was one of the worst months for stocks in a decade, and the sell-off left every major asset class in the red for the year. This month, some welcome calm has returned and buoyed markets once more. Do you think that the biggest market risks, the Fed hiking rates too rapidly, US-China trade war and global recession, have now subsided?
I think obviously some of these factors are still in play, but I think the perfect storm that we saw last year in terms of tightening of dollar liquidity, whether you talk about quantitative tapering, rising interest rates, widening credit spreads and the stronger dollar, that's probably behind us. So I think we will see things in 2019 improve slightly. That said, it's not going to be smooth sailing. There's likely to be significant volatility. So it's really important to be able to prepare and take advantage of that volatility as and when it arrives.
But do you still expect some more upside in the equity market?
So the central scenario is still that equities do actually quite well this year. If you look at corporate earnings growth, still reasonable, certainly nothing like what we saw last year, but still looking at around high single-digit earnings growth globally. And obviously valuations are now significantly cheaper. So if we do see those headwinds ease, then we should see equity markets have a reasonable 2019.
The consensus seems to be that there will not be any imminent recession. And people say that, analysts say that equities tend to do pretty well at the end of a market cycle. So do you believe investors will be rewarded for taking equity risk?
Yes, we do. So you're right. Actually, in the very late stage of the cycle, you usually see actually quite strong equity market returns. The only caveat to that is, while the central scenario is for no recession, we estimate there's around a 1 in 3 chance of a recession this year. So it's really important to manage your allocation, saying yes, still remain exposed to equities, but then also make sure you offset that or complement that by being invested in other asset classes. So whether that be bonds or actually some money on the sidelines in cash, we believe that's something that's really important to weather any volatility as and when it arises.
And what kind of recommendations do you give to equity investors? Are there any geographical areas that you focus on?
For now, we're still overweight the US market, so that's our preferred market. So clearly, again, earnings holding up reasonably well, but certainly not the 20% plus that we saw in 2018, but still mid to high single digits. Share buybacks are there. So we had $750 billion-ish last year. We're looking for more share buybacks to come through in 2019. And one thing is that the trade tensions that we've seen, the US, we believe, has good control over, if they want to solve the trade tensions in the short term, they just have to talk to China. So if the market does weaken at all based on trade concerns, then the US has the power to sort of reverse that.
And some asset allocators believe that EM stocks are pretty attractive because of valuations, but also because lighter investor positioning and sentiment, and also because the dollar is expected to weaken. What's your position on emerging market stocks? Do you agree with this?
Overall, within emerging markets, we favour Asia ex-Japan. So Asia ranks second in our geographic preferences. So the cheap valuations is a part of that. Corporate earnings also holding up. And as you mentioned, if the dollar stabilises or weakens, we're not looking for a massive weakness of the dollar this year, but even slight weakness, that should reduce the headwinds for Asian equities. China growth is a key factor that everybody's focused on, but we're not worried about that at all. We believe the authorities are very able and also willing now to take measures to support the economy, which again should be positive for Asia ex-Japan equities.
So trade tensions, do you think, are not going to impact China's growth so much? Or?
So obviously we don't know how that's going to play out. We should find out in the coming weeks. One thing that we're very clear on is that China is willing to compromise. It's already made some pretty big statements in terms of intent. There's also signals that they'll do things on the intellectual property rights if they want, or even maybe compromise some of its made in 2025 objectives to try and strike a deal with the US. So the key question is, does the US want a deal or not? I think in beginning of December, that was a really big question. After the weakness we saw in December, I think the US probably does want a deal now.
And finally, Steve, does it pay off to have contrarian views today in this market environment?
I think if you wind back 3, 4, 5 years, I think contrarian views probably were less worth considering because we were being pushed into risky assets at that time, so whether it be equities or high yield bonds and the like. As the interest rate cycles normalised and we get later in the economic cycle, the whatever it takes type statements are less likely to be coming, and I think therefore contrarian trades may become more interesting as we go forward. So, one thing that we're looking at the moment, so we're underweight euro area equities, but it's really difficult at this stage to find anybody that's really positive on euro area. So if we were to see a catalyst for a revision of that, that would be something I think would be really interesting. And on that, we're looking at the banks. So if the economy was to stabilise, the ECB was to hike interest rates, that could be a catalyst for a re-rating in the banks and therefore euro area equities.
Thanks very much, Steve, for joining me.
Thank you.